The US continues to raise the heat on Russia over its attack on Ukraine. In its latest round of sanctions, Washington is slapping sanctions on entire sectors of the Russian economy. On Thursday, President Joe Biden approved sanctions on dozens of companies that US authorities say serve as shell companies for the Kremlin, helping to evade international restrictions and procure supplies for the aerospace, marine and electronic industries. The country's biggest microchip manufacturer, Micron, along with three other companies that make microelectronics, navigation equipment, and satellite imaging software, are also facing restrictions. And its allies like the EU, Japan, Australia, and the UK are implementing export controls on many of their products to ensure Russian companies cannot buy them through intermediaries. But attempts to cut off Russia's biggest income source seems to be much less successful. The US is pressing allies like Saudi Arabia and the UAE to bolster oil output to replace a potential loss in supplies from Russia. But OPEC and its allies say the global energy trade should not be politicized.
We, as a country, are trying to do our best. We are investing in raising our capacity to the 5 million barrels. We said this when people were saying you should not invest. And we were wise to do that because now we're seeing the need for it. So we are continuing on that pathway. But that does not mean that we are going to leave OPEC Plus or do something unilaterally. We will work with this group to ensure that the market is stable.
When they convened on Thursday, members of the cartel announced they would limit output increases to levels agreed upon last year. OPEC will boost supplies by as much as 432,000 barrels per day from next month. Several members have already failed to keep pace with the planned output increases and say they are unable and unwilling to replace Russian supplies. Their refusal to significantly boost oil exports means energy prices will likely continue to climb. For now, President Biden is mitigating that impact on his own constituents by authorizing the release of the country's strategic energy reserves.
I'm authorizing the release of 1 million barrels per day for the next 6 months, over 180 million barrels from the Strategic Petroleum Reserve. This is a wartime bridge to increase oil supply until production ramps up later this year. And it is by far the largest release of our national reserve in our history.
And while that's expected to provide some relief to U.S. consumers, analyst Youssef Al-Shammari says it may not last long term.
Now the United States is withdrawing 180 million barrels from its strategic reserves for 6 months. So that means 1 million barrels a day. So the current production from the U.S. is about 11.6 million barrels. So adding to the 1 million barrels, this is close to 12.6 million barrels. And this is very close to the U.S. production before the COVID-19 levels. So it's got a bit of a weight that can already impact on the sharp prices that we have seen over the past weeks. Now, how can that last? I don't expect prices to go to skyrocketing levels with this action being taken from the U.S. But I don't also believe that it can do much in terms of lowering the prices very much below $100. So I would expect the price will stabilize with high 90s or slightly above $100 with that U.S. action being undertaken. Of course, I would exclude the possibility of an Iran deal, and that's the major reason why the U.S. also actually has taken that decision of withdrawing the strategic petroleum reserves. But one important thing here is that it's about demand levels. And could these high prices lead to a switch and a change in consumer behavior? And that's something we expect towards the end of the year. So we expect prices to go much lower than what we're seeing today towards the end of the year because of demand destruction and possibility of an inflation, more than what we are seeing from strategic petroleum reserves right now.